Hi folks, Jason from Montax Accountants here. In today's video we're going to explore the relationship between profit or loss and cash flow and why these things are important. So let's look at a basic illustration of this. In example 1 we have sales of £100, our purchases of £45. Therefore, we've made a profit of £55. In example 2, we've made sales of £40, purchases of £45, and therefore a loss of £5. So what is the effect of either a profit or a loss? Well, looking over at our bank account now, we can see we opened with a balance of £200. In example 1, we have purchases of £45, we've sold the goods and we've realised a further £100, which is our sales figure over there, okay? So our bank balance has moved upwards by £55, from £200 to £255. That's all well and good, okay? But what happens when we have losses in our business? Well, in example 2, we sold at £40, which was £5 less than our cost price. So therefore our bank balance has gone down by £5, from £200 to £195. Not good. In this example here we can see a direct relationship between the profit or the loss and the bank balance. Stay with me. In part 2 we're going to explore why in some occasions, in fact for most businesses to be truthful, they may not see as dramatic a swing in their bank account when they're sustaining losses. Stick with me, I'll see you on the other side. Hi folks, welcome back. Jason here on Tax Accountants again. In part 1 of this video we looked at the effect of profit or loss on the bank balance. In part 2 of this video we're going to consider firms that are constantly buying or selling services on credit terms, so the reflection doesn't necessarily happen in the bank balance straight away. So let's follow this example through, okay? As before, we've got a profit of £55 on example 1, and on example 2 a loss of £5. We've still got our opening balance at the bank of £200. Now, let's imagine that in example 1 here, that the person to whom we've sold the goods has not paid cash yet. They're going to pay sometime in the future. So we now have what is called a debtor, someone who is indebted to us. So let's put that down. Example 1, a debtor of £100. We've also bought goods for £45 on credit terms. So we have a creditor, someone to whom we owe money, £45. Okay, looking at example 2 now, in this one we sold some goods for £40. Once again, this person isn't paying straight away, they're going to pay at some future point. They are therefore a debtor to us. So we'll put the debtor of £40 in there. And again, we have bought the goods on credit, so we have a creditor of £45. Okay, now at this point, the bank balance hasn't moved at all. No one has given us money, no money has gone out of the bank account. What is the real position of the business? Well, in example 1, we have a debtor of £100 and a creditor of £45. So we can say that the position is as follows. A debtor is an asset to the business. They have something that they're going to give to the business at some future point. A creditor is someone to whom we owe money to. They are a liability. So deducting one from the other, in example 1 here, the business has a net asset of £55. In example 2, because more money is going out than coming in, we have a net liability of £5. Why do we use these expressions, net asset, net liability? Well, once we measure everything that the company has versus everything the company owes, it brings us to a net position, and that tells us the true health of a business. So in this example here, this business is very strong. It has money in the bank account and it's owed money. But this business here, the second one, yes, it has money in the bank, but it owes money out. This clearly demonstrates that profit or loss don't necessarily turn up in the bank account straight away. In fact, at this point in time, our bank balance is still £200. We have money due in and money due out. The big question is though, these people that owe us money, are they going to pay? And this is why managing your cash flow is probably the most important thing you will ever do in your business. It's easy to generate paper profits. Some people are good at generating paper losses, but we don't have many of those on our books. So it's easy to generate paper profits, but until we realise that money, until Mr. Debtor here turns up with his £100, we lodge it in our bank account, then we can go and pay the person we bought the goods off. In fact, let me just change that around. I have done it the wrong way around. There we go, and the bank balance will now move by £55. It's important to get the cash flowing into the business as fast as possible and the cash flowing out of the business as slow as possible within reasonable terms so that we can maintain this bank balance. If money flows out too fast, our cash flow will go down. We can end up putting the cart before the horse, as I just did fairly deliberately a minute ago to demonstrate that fact. Stay with us here at OnTax, we've got plenty more tuitional videos coming. Thank you.